Hey, so let's just get right to it. One of the biggest pharmaceutical companies in the world, Eli Lilly, is in a full-blown war over its billion-dollar weight loss drugs. They're trying to stop smaller online companies from selling cheaper copycat versions of their product. But a court ruling recently just dealt them a massive blow, and in the process it may have unlocked one of the most interesting investment opportunities of the year. Look, if you simply refuse to listen to a random guy hiding his face on YouTube, here is the single most important takeaway. The court essentially just gave a legal green light to the entire telehealth business model for selling these compounded drugs. This sent the stock of one company, HIMS and HERS, soaring on September 4th. And today we're going to break down exactly what happened fundamentally, along with its technical picture. For those of you who are new here, my name is DataCat. I used to be an analyst, one of those spreadsheet jockeys inside a big Fortune 50 company. I traded that in for, this. My goal here is to cut through the noise and look at the data behind these big market moves. If you appreciate that kind of no-nonsense analysis, maybe consider subscribing. It helps the channel out a lot. Alright, so to really understand what's going on, you have to see this for what it is, a classic David versus Goliath story. On one side, you have the giant Eli Lilly. This is a massive, massive pharmaceutical company. They poured billions of dollars and years of research into creating these blockbuster weight loss drugs, Zepbound and Mounjaro. I'm not sure how it's pronounced anyways. And because of that investment, they hold patents on them, which gives them the exclusive right to make and sell these specific formulas. On the other side, you have the newcomers, companies like HIMS and HERS. They're telehealth platforms. They don't invent drugs. What they've done is build a very slick, very easy to use online service that connects you with a doctor. You have a virtual consultation, and if the doctor deems it appropriate, they'll prescribe medication that gets shipped right to your door. It's all about convenience. So, where did the conflict start? Well, the problem is, the demand for Eli Lilly's drugs is so incredibly high that they've been facing shortages. They literally can't make it fast enough. Now, when a drug is officially in short supply, the law allows for a special kind of pharmacy called a compounding pharmacy to step in. These pharmacies can legally create their own versions of the drug. It's not the official brand name stuff, but a copy made from the base ingredients. Eli Lilly saw this as a backdoor, a grey market chipping away at their empire. They argued that these telehealth companies were creating a channel for these copycat drugs, infringing on their patents and raising safety concerns. So they did what any giant would do. They sued to shut it all down. This brings us to the court ruling. The judge basically looked at the situation and said that as long as a real licensed doctor is involved in prescribing the compounded drug to a specific patient, and there's no evidence of widespread harm, then the telehealth company isn't the one doing anything wrong. This ruling validates the very core of the HIMS business model. It provides a legal shield. The market saw this and, it pounced. Like a cat on a laser pointer dot it can't actually catch, but the enthusiasm is real. The ruling was seen as a major de-risking event for the entire industry, which is why HIMS's stock shot up. So, a lawsuit gets dismissed, a stock pops. What does this mean for us? How do we turn this news into a coherent investment idea? The investment thesis is that HIMS and HERS, as a nimble and consumer-focused platform, is now in a prime position to capture a significant share of this enormous weight loss and lifestyle drug market. The court ruling has removed a major legal threat that was hanging over the company's head. Let's look at the bull case, the reasons this could work. First, the convenience factor is huge. HIMS has absolutely nailed the user experience. Their platform is discreet, it's easy, and it removes all the friction of having to go to a traditional doctor's office. That is a powerful advantage. Second, there's diversification. While weight loss is the hot topic right now, HIMS has a growing business in other areas like hair loss, mental health, and erectile dysfunction. This provides a bit of a safety net if the weight loss market gets too crowded. And third, of course, is the legal shield we just discussed. This ruling sets a precedent that will make it much harder for Big Pharma to attack this business model in the future. But it's not all smooth sailing. We have to look at the bear case. What could go wrong? First, this fight is not over. Eli Lilly and other pharmaceutical giants are not going to just give up. They have incredibly deep pockets and will likely appeal the ruling or find other ways to attack the telehealth model. This legal battle could drag on for years, creating a lot of uncertainty. Second, there's regulatory risk. The FDA could at any point change its rules on compounding pharmacies. If they tighten those regulations, it could severely impact HIMS' ability to source and sell these drugs. And finally, there's competition. HIMS isn't the only player here. As the legal risks go down, you can bet more competitors will jump in, and that could drive down prices and profit margins. Now, it's important to remember the world we're investing in right now. It's September, and the market feels, well, fragile. Like a cat walking on a very thin branch. There are a lot of significant economic events happening, creating a ton of volatility. So just knowing about this lawsuit isn't enough. We have to ask the critical question. Is HIMS, this small-cap high-growth company, the right place to put your money in such a shaky market? Or is this a classic trap? For the last 2 months, the stock was basically asleep. It was stuck in what we call a sideways primary trend, grinding back and forth in a wide range between roughly $41 and $60. The momentum was weak, technical indicators were bearish, and more money was flowing out of the stock than into it. The most telling thing about this period is that the stock had a high dependency on a catalyst. It wasn't moving on its own merits. It was just waiting for a reason, any reason, to make a big move. And then on September 4th, it got one. This wasn't just a good day for the stock, it was a technically significant event. The stock gapped up at the open and just kept running, closing up over 8% for the day. This is a gap-and-go pattern, and it shows an extreme urgency from buyers. They weren't even waiting for a small dip to get in. They wanted in, and they wanted in now. Crucially, this move was confirmed by huge volume. The trading volume for the day was nearly double its 20-day average. You see, a big price move on low volume can often be a fake-out. But a move on massive volume like this suggests that large institutions are participating, and that gives the move a lot of credibility. The momentum completely shifted. For the last month, the RSI has been mostly below 50, which points to bearish momentum. In this single session, it shot up to 51.5. The money flow index also jumped, showing that all that high volume was driven by buying pressure. The stock also managed to close at $48.11, pushing it just above a key technical level at $47.12. That level, which was previously a ceiling, will now be watched as a potential new floor of support. So, what does all this technical jargon actually mean for an investment decision? It means the game has changed. The technical posture has shifted dramatically from bearish or neutral to short-term bullish. The lawsuit news provided the jolt needed to break the stock out of its funk. The next big test is the 50-day moving average, which is sitting right around $50. This is now the most critical ceiling to watch. If the stock can break through and hold above $50, it would be a major confirmation that a new sustainable uptrend is beginning. It's also possible the stock might trade sideways for a few days. If it holds its ground above that new support level around $47 to $48 on lower volume, it could be forming what's called a bull flag, a classic pattern that often leads to another move higher. The risk, of course, is what we call a gap fill. If the bullish momentum fades, the stock could drift back down to close the price gap it created on the morning of September 4th. That would take it back down to around $44.50. A break below that would be a bad sign. Okay, this is probably the single most important rule to remember after a day like this. You do not chase a nearly 9% green day. The fear of missing out is a powerful emotion, but buying at the peak after a huge run is rarely a good strategy. The stock is technically overbought in the very short term. A pause or a small pullback is healthy and should be expected. So let's talk strategy. This is not financial advice, but just imagine we are playing chess. I see 3 potential ways to approach this, depending on your risk tolerance. First is the aggressive bull flag entry. This is for someone who believes the news is so powerful that the stock will barely dip. The potential entry zone would be between $47.10 and $47.80. The idea is to buy the very first small dip, anticipating that consolidation before the next move up. The risk here is that you're buying very close to the top, and if the momentum fades, the price could drop quickly. Second is the moderate gap fill entry. This is a more patient approach. The potential entry zone here is between $44.50 and $45.50. It's a very common pattern for a stock to eventually return to the price level it jumped from. Buying here means you're getting in where the explosive move began, which is often a powerful area of support. The risk? The stock might be too strong to pull back this far, and you could miss the entry waiting for a better price. Third, for common folks like me, is the conservative confirmation entry. This is for an investor who wants proof that a new uptrend has truly begun. The entry here would be a break above $50, followed by a dip back to test that $50 level. The logic is to wait for the price to close above that major resistance, and then enter when it proves that old ceiling has become a new floor. The risk is that you'll be buying at a significantly higher price than the other two strategies. You basically sacrifice the initial part of the move in exchange for more confirmation. And remember, September is a month that requires investors' utmost patience and caution. Now, no matter the strategy, keep an eye on volume. Any pullback should happen on lower volume. If the stock starts to fall on volume that is as high as it was on September 4th, that's a major red flag that sellers are taking control. If this is the kind of detailed data-first breakdown you find valuable, consider subscribing to the channel. It lets me know I'm on the right track. Alright, DataCat out. Stay safe and stay sharp out there.